Assalamualaikum and very good morning to Madam and everyone. First of all, we would like to thank Dr. Nurul Hafiz Abeti Hashim for giving us opportunity to present our group assignment for FBB 20903 Consumer Banking. My name is Muhammad Afif Zafri bin Muhammad Yusof and my metric number is 079780. I am representing Group 8, which is consists with other 4 members. Today, our group will present our assignment entitled Credit Evaluation of Potential Borrower. For this assignment, we assume the role of junior executive in financing department of a financial institution, where we are required to evaluate a potential borrower based on the company's financial information and credit worthiness. Our presentation focused on evaluating whether the borrower is suitable for loan approval by applying the principle of good lending, the 5 C's of credit, and financial statement analysis. We also include other relevant factors to provide a more comprehensive assessment and conclude with our recommendation regarding the proposed loan amount of RM500,000. Without further delay, I would like to invite other members to present their part.
My name is Nushalira binti Mama Hafiz and my metric number is 080250. So for this credit evaluation, we selected Asia Poly Holding Berhad, a Malaysian public listed company on Bursa Malaysia since 2005. The company is involved in the manufacturing and retailing of plastic products, mainly serving the food, retail, signage, construction, transport, and medical industries. Since its incorporation in 2003, Asia Poly has expanded its market internationally, exporting products to countries such as the United States, Japan, Australia, India, and the Middle East. Despite operating in a challenging environment with rising raw material costs and supply chain disruption, the company has continued to focus on operational efficiency and sustainable business practice. This report evaluates Asia Poly Holdings Berhad application for a 500,000 loan by analyzing its financial performance, applying the 5 C's of credit, assessing its creditworthiness, and determining its ability to repay the loan. Next, let's look at the company key financial figures for full year 2024 and full year 2025. The company recorded revenue of 170 million ringgit in full year 2024, although revenue decreased to 88.99 million ringgit in full year 2025. The company managed to improve its profitability significantly. Asia Poly achieved a net profit of 407,000 ringgit in full year 2025, compared to a net loss of 11.22 million ringgit in full year 2024. This indicates a successful turnaround in its financial performance. In terms of debt management, total debts decreased from 62.04 million ringgit to 57.4 million ringgit, showing that the company has reduced its financial obligation. At the same time, shareholders' equity increased from 122.07 million ringgit to 124.5 million ringgit, reflecting a stronger financial position and improved shareholder value. Furthermore, current assets increased to 83.11 million ringgit, while current liabilities declined to 52.22 million ringgit, resulting in a stable net current asset position of approximately 30.89 million ringgit. Overall, despite lower revenue, The company demonstrated stronger profitability, reduced debt, and improved financial stability, which are positive indicators for its loan application. That's all from me.
Assalamualaikum warahmatullahi wabarakatuh. My name is Vehicle Berhad Gazla and my metric number 081254. I will present on this slide. So let's dive straight into the financial hub of Asia Poly. In here, we look at the liquidity and profitability. First, let's talk about liquidity, or in simple term, the company cash cushion. If you look at the current ratio, it actually improved from 1.48 to 1.59. What does this mean? It means for every 1 ringgit of short-term bill they are on, they now have RM 1 ringgit and 59 cent in liquid asset to back it up. Even when we look at the quick ratio, where we ignore the inventory because stock take time to sell, the number still went up to 0.85. So from a liquidity standpoint, they are in a very safe spot. Now, let's look at profitability. This is where the real turnout happened. 2024 was honestly a tough year for them. They hit a net loss with a negative margin of minus 9.59%. But look at 2025. Even though their total sale drop, their gross profit margin did a massive jump from 3.71% to 60.3%. This tells us that management did a fantastic job cutting down production costs and pricing their product better. They are successfully dragged the company out of the red and back into making a clean profit. Moving on this slide, let's look at leverage and efficiency, or basically how they handle their debt and how fast they move their stock. On the leverage side, Asapoli is doing something really smart. They are actively lowering their debt. Their debt to equity ratio dropped to 0.46 and the overall debt ratio went down to 28%. This tells us they are using more of their own money to run the business instead of just relying on bank loans. This conservative structure keeps the company safe and give them plenty of room to take on this new 500,000 loan without any stress. Now, to be honest, their efficiency slowed down. Their inventory turnover dropped to 2.31 because market demand for plastic was quite slow. But here the interesting part, it didn't actually hurt them. Why? Because the higher profit they made on each item sold completely covered the delay. So, the cash flowing into the company stay very safe and stable. To wrap everything up, let's look at the big picture here on this slide. If we connect all the dots, the story of Asia Poly over these 2 years is a very classic comeback. We can see 3 main takeaways. Number 1 is a stronger balance sheet. They build a better cash safety net. So, their immediately bill are well under control. Number 2 is the operational turnaround. That jump in profit margin to 16% completely wiped out the heavy loss from 2024 and brought back the profit. And number 3 is lower credit risk because they've been consistently paying off all debt. The risk for the bank is now much lower. So, the final verdict, the business is now smarter, learner, and making more profit per sale. Their cash flow is healthy and steady, which is exactly what a bank looks before approving a loan. That's all from me. Thank you.
Assalamualaikum. My name is Ali Hassan bin Ahmad Aswadi and my metric number is 079890. First, let's begin with character. Asia Poly has been operating for over 30 years, and it is been listed on Bursa Malaysia since 2005. So this is not a company with a short or shaky history. Looking at leadership, the executive chairman, Dato' Yeo Bon Leong, holds a significant personal stake in the company, which usually signals confidence from the top. There are also two independent non-executive directors, which adds a layer of oversight and accountability. However, we can't overlook that the company posts 4 consecutive years of losses from 2021 to 2024. The disclosure around this has been transparent, which is a positive sign, but the losses themselves are something a lender would want to dig into further. Balancing the long track record and strong leadership commitment against those recent losses, so we rated character a 3 out of 5, just average. Next, we look at capacity, which look at the company's ability to repay debt. Revenue actually grew nicely, reaching 117 million ringgit by final year 2024. But despite that growth, the group still recorded a net loss of 11.2 million ringgit in the same year, largely driven by volatile costs of MMA monomer, which is a key raw material in their production. There's a silver lining though, because final year 2035 saw a turnaround into profit with a net profit of about 407,000 ringgit. Still, when you calculate the net margin, it comes out to just 0.46%, which is extremely thin. This tells us repayment capacity is only moderate right now, and any new borrowing the company takes on needs to be structured very conservatively to avoid putting pressures on cash flow. Given this, we score capacity 2 out of 5. It's totally poor. Third, let's take a look at capital, which examines the financial cushion the company has. The good news here is that net tangible assets stand around 126 million ringgit, and the NTA per share actually improved from 0.11 ringgit to 0.12 ringgit, which confirms the company remains solvent. However, there's a noticeable gap between this book value and how the market values the company. The market capitalization is only 79.1 million ringgit, which works out to just 0.63 times book value. This discount suggests investors are skeptical about the true value or future performance of the assets. On a more positive note, the company has a bonus warrant scheme in the place that could raise up to 37.69 million ringgit for working capital, giving it some flexibility going forward. Weighing the solid asset base against the market's cautious view, we give capital a 3 out of 5. Moving on to collateral, which looks at what assets could back a loan if things goes wrong. Asia Poly has a fairly diverse asset base, including manufacturing plants, land held through high reserve land SDN BHD, trade receivables, inventory, and even renewable energy installation. On paper, that's a reasonable spread of collateral types. The concern, though, is that specialized manufacturing machinery tends to be difficult to liquidate quickly if needed, since there's a limited pool of buyers for that kind of equipment. And again, the fact that market cap sits below book value raises some doubt about how easily this asset could be sold at their stated values. Because of this, any collateral here will need independent valuations, and lenders should apply a haircut to be safe. Taking both the variety of assets and the concerns into account, we scored collateral a 3 out of 5. Finally, we have conditions, which look at the broader business environment the company operates in. On the positive side, Asia Poly has diversified end user segments and exports to markets including the US, Japan, Australia, India, and the Middle East. This geographic spread helps reduce the risk of being too dependent on any single market. That said, there are real headwinds to consider, including volatility in MMA prices, exposure to currency fluctuations, and ongoing competition in industry. Looking ahead, there's some long-term potential from renewable energy initiatives under the SEDA feed in a tariff scheme, as well as from the Darwell acquisition. Balancing the diversification benefits against the operational risk, we landed on a 3 out of 5, also 4 condition. Thank you.
Based on our overall assessment, our group recommends approving the 500,000 ringgit financing facility for Asia Poly Holdings Berhad, subject to appropriate lending conditions and continuous monitoring. This recommendation is supported by the principle of lending that we have been discussed. Firstly, from the perspective of risk-taking, every lending decision involves a certain level of risk. Although Asia Poly experienced several years of losses, the company showed clear recovery in 2025 by returning to profitability. In addition, its current ratio improved from 1.48 times to 1.59 times, while its debt to equity ratio decreased from 0.51 times to 0.56 times. These improvements suggest that the level of credit risk remains manageable and acceptable for the bank. Secondly, under the principle of quality of credit, lending decisions should be based on the borrower's ability to repay, rather than relying solely on collateral. Asia Poly generate approximately RM 89 million in revenue during 2025 and successfully returned to profit after previous losses. This indicates that the company continues to operate actively and has an improving repayment capacity. Thirdly, the principle of purposeful and productive lending is also satisfied. The proposed financing will be used for working capital, raw material purchases, and manufacturing operations. These activities directly support the company's core business and are expected to contribute to future revenue generation and business growth. Finally, the principle of protection and control further strengthen our recommendation. The company has substantial assets, inventories, and receivables that may be used as collateral. At the same time, the company has established a risk management and internal control system through the Sustainability and Risk Management Committee and the Audit Committee, providing additional assurance to the lender. Therefore, after considering all relevant lending principles, we believe that proposed RM 500,000 ringgit financing facility should be approved with suitable lending condition and ongoing monitoring. In conclusion, our financial and credit assessment indicate that Asia Poly Holdings Berhad has shown meaningful improvement in its financial position despite operating in a challenging business environment. Throughout the analysis, we found several positive developments. The company's successful return to profitability in 2025 after experiencing losses in previous year. Liquidity also improved, with the current ratio increasing while leverage decreased as the debt to equity ratio improved from 0.51 times to 0.46 times. These trends indicate stronger financial stability and lower financial risk. From the 5 C's of credit assessment, the company demonstrated acceptable performance in terms of character, capital, collateral, and conditions. although its repayment capacity remained moderate due to relatively low profitability, there is clear evidence that the company is still moving in the right direction and strengthening its financial position. In addition, the company maintains a substantial asset base and continued to generate significant revenue from its core operations. This factor provides confidence that the company has the ability to meet its future financial obligations, provided that its recovery momentum continues. Overall, Asia Poly Holdings Berhad can be classified as a moderate risk borrower with an acceptable repayment capability. Therefore, the proposed RM 500,000 ringgit financing facility is considered reasonable and may be approved subject to sufficient collateral, suitable financial covenants, and continuous monitoring by the bank. We hope this presentation has provided a clear understanding of the topic that we discussed and add a valuable knowledge for everyone. Thank you for your time and attention.